Welcome back, guys. So in this particular session we will be discussing about property, plant and equipment. Okay, IAS 16. So what we've been basically been given is that we've been given it's prepared by IAS 16, right? That means it's before 2001. Okay, so that's its history, and then let's look at it as well. So property, plant and equipment, right? Okay, let's move my fist to the other side. What's this? Okay, that's a bigger bubble. Don't need that. Let's see. Nope, we can't fit it. So I'll just put it up there. Put it over there. Right. So basically, how is IAS 16 defined is that basically it's defined as an tangible items. Okay, IAS 16 only applies for tangible items. Is basically it has a physical form that you can touch by your hand. Okay, always remember that. And then it is held for use in production and supply of goods and services. Normally normally it is held for production and supply of goods and services. Sometimes it becomes very hard. Okay, so sometimes it might be a PPE as well, and then you might be using it as an inventory as well. Okay, so that becomes a bit harder in some cases, but the actual definition is the tangible items that are held for use in production or supply of goods or services for rental to others or for administrative purposes. Okay, it's basically for supply, production and supply of goods and services. That's what you need to remember. Okay, or for administrative purposes as well. Okay, and then it is expected to be used for more than one period, 1 year. Okay, so it's basically like a qualifying asset. Okay, so in qualifying assets it's more basically same thing, right? For more than one period. Similarly, so how will we recognize PPE is that the recognition of the item will be when it is probable that the economic assets future economic benefits will flow into the entity. This is a old definition. Okay, so the conceptual frameworks has changed, whereas in that case it's not talking about potential future benefits. Okay, so it's not talking about benefits will flow into the entity. It's not talking about that. So this is based upon old framework. Okay, that's why. And then the cost of the asset can be measured reliably. Okay, so the cost you need to be able to measure it properly. Okay, otherwise if the measurement is not good, then it's no use, right? It's not a relevant and faithful representation. Our main fundamental characteristics of our financial statement will be breached. So in your initial recognition, so how will you recognize a PPE in your initial recognition is that basically, uh, first of all is purchase price. Okay, so you need to include the purchase price and then any discount that you have, that will be included in that, right? So when you get the bill, you'll be basically getting it out there. So your purchase price less any discount or rebate, and then you can also add import duties and non-refundable purchase taxes such as stamp duty, the taxes that you pay. Okay, that will be added up, right? But it's always measured at cost. Okay, and then what else we can also add to that is that basically the cost which is associated to bring that particular asset, whether it's a plant or building, to the working condition. Okay, so if it's a plant, then like you might want to bring the machineries to the site, right, in a working condition. uh, so during that period what you will have is that you'll incur cost such as site preparation. So you'll need the excavator to dig the ground and all, right? Then level it up first of all, or dig it up, and then after that basically, and then your inventory or your thingy will come from there, your machinery will come from your supplier, so there will be the delivery cost and then the handling cost for the labor, right? And then after that, so some qualified person will come and install it, test it, right? So and then all these things will be as per the advice of engineer and architect, right? So there will be cost associated with that as well. And then if it is purchase on a loan, or what you could say is that borrowing cost, if you are talking about that, you could say like interest cost or any other cost associated with borrowing. Okay, that's the standard definition. I would like to use that only. Okay, so it's not only interest cost and other cost associated with borrowing. Okay, so sometimes you might incur a few costs, right? So that is as per IAS 23. These costs must be included in your initial recognition. Okay, so what are the costs that will be included is purchase price, your taxes, and then the cost associated with bringing that asset to uh, to that particular location and its condition. Okay, its working condition. So if you are bringing the asset, it should be working as well, right? As normally it should function. Okay, and then you'll also have to include this cost. Okay, so mostly people forget about this. So cost of dismantling, or we call it unwinding cost. Okay, so these are unavoidable, such as like nuclear plant, right? So after the project has been finished, they'll have to dispose that thing, right? So it will cost them a lot of money, right, for the environmental and all, and then it should be safely disposed of. So even though that cost is being incurred in the future, so it'll be after a very long period of time, right? So what we will need to do is that we will need to bring that particular amount into the present value. Okay, so you'll have to bring it to present value, and then every year what you will do is you will increase it with finance cost, right? So we will be doing that sort of problem as well. That will help you. But I have a special question that I have solved. Okay, so I have another video as well, where in that I have talked about all this cost, and there is a specific questions regarding this. Okay, have a look at that. So when you're capitalizing, so we get confused in normal things, right? Okay, so what happens is basically, even though these costs are not to be capitalized, people tend to capitalize it just for this, it is sake just for the sake of being easy. Okay, so what are the costs that we should never capitalize is that administrative and general overheads. Okay, first thing. Second thing will be your abnormal cost. What are abnormal cost which is associated with repairs, wastages, and then when you have ideal. Okay, so even though the machinery is prepared on June, but it's only starting to work from July, that means 1 month of ideal period, right? That should not be capitalized. Okay, and then the depreciation starts from that day itself when the asset is ready, right? So cost incurred after the asset is physically ready for use. Okay, so after the asset has been ready for using, so even though if we don't use it, the cost which are associated with that should never be capitalized. Okay, and then unless there is a criteria as well. So unless that cost will enhance that particular asset, or it will bring more economic benefits as a result of that enhancement. Okay, and other cost is cost incurred in initial operating period, such as initial operating losses, like test run, right? So you might bring a machinery, and then after that you might launch a new product as well, right? So based on that, you might be incurring few costs, so we should not capitalize that as well. Similarly, we should not be capitalizing the cost of opening a new facility. Okay, such as like we do few promotions and all, right? So advertising cost and all that should not be capitalized. Okay, you can't basically just capitalize it. And then if you're moving that particular plant or machinery, the cost will not be capitalized. It will be general expense. That means it will be charged into SOPL. So what does this capitalizing mean? I'm saying capitalize, right? So it's basically the value of PPE in the balance sheet will be, uh, if you capitalize it, it will go up, okay? So the value will be overstated, and if you don't capitalize it, it will be understated, okay? And then the cost of relocating and reorganizing, I've already talked about that, right? So relocation and then restructuring as well, or reorganizing an entity's operation. Yeah, restructuring, those costs should not be capitalized. We have a separate thing about that as well. Restructuring, where was that? Assets held for sale and discontinued operation, IFRS 5, we'll be looking at that. So subsequent expenditure. So subsequent expenditure should only be capitalized if it enhances the economic benefits provided that particular asset, such as it could be expected useful life, right? Or increasing the productivity of that particular asset. So the product should be more efficient, right? So you might be uh, changing some part, and then so you might change, if there is a big machinery, so you might change that engine of it, right? So that it will be more efficient, such as aircraft, okay? And then similarly, when you're talking about aircraft, what happens is the engine that you have just replaced, so it will need replacement after 10 years or so, right? So what happens is basically that will be accounted for as a separate asset, okay? And then it should be capitalized over its next. So whenever you do a next overhaul, so next change of that engine, during that period of time you will be depreciating it. By the time that day comes, the value will be nil, okay? So basically in case of aircrafts, mostly it happens with that, okay? It needs a overhaul every 10 year or 15 years, some period like that, okay? But all you need to remember is that the separate component will be treated as a separate asset. Just keep that in your mind. You should be good to go. So similarly, expenditure incurred in replacing or renewing a component of an item of PPE must be recognized in the carrying amount of the item, and the carrying amount of the replaced and renewed item must be derecognized. Okay, so all it means is that basically what happens is, so normal, on a normal condition, so if you have already made a separate component kind of thing, right? So you will be depreciating it. By the end of the changing period, what you will have is you'll have a zero balance. You don't it will be automatically be derecognized, right? But what it just means is that basically the engine that you're throwing out, you need to derecognize that and then add the other engine that you're purchasing, okay? That's all it basically means. So subsequent measurement. So whenever we are talking about subsequent measurement, so there is two types of subsequent measurement that is offered. And then basically the first model is cash model. So in this, basically what we basically do is that cost less accumulated depreciation and then accumulated impairment, okay? So accumulated depreciation will be the depreciation from years onward. Accumulated impairment is basically the impairment over the year. So revaluation will be basically it's on the asset at a revalued amount, and then basically what you need to do is the assets values might change, okay? So basically it might go up as well, it might go down as well. That will be based on the market, right? So the valuation will be done as per IFRS 13 fair value measurement, okay? And then what will be the balance recorded is that fair value less accumulated depreciation less impairment or accumulated impairment, okay? So similarly, in case of revaluation model, so if it is adopted, these things must be complied with, okay? So revaluation must be done on a regular basis. So it should be done on a regular basis at each reporting period, so that there is no material difference between that amount, okay? So what is material? Whose submission, whose omission or misstatement might change the decision of the investor. Okay, that is your materiality. Okay, anything which is material. Okay, so if an item is revalued, the whole class of asset to which the item must be revalued. Okay, so if it belongs to a particular class of assets, the whole asset should be revalued. Okay, or you should use revaluation model. So treatment, how you will basically be accounting for this is that, so any increase will be shown in OCI and under the heading that the item will not be reclassified or recycled to profit or loss in subsequent periods. Okay, so we'll be doing some examples that will give you a bit of clarity, but just remember that it will be going into OCI. Okay, so if there is a revaluation decrease, it will be recognized in SOPL. Okay, unless there is a revaluation reserve which will be decreased otherwise. So if the value has already, so suppose the asset was had a carrying amount of 80,000, and then there was a revaluation of, let's say, revaluation surplus, revaluation of, let's say, 90,000, right? So after you've done your depreciation, suppose the value is now 85,000, so you have 5,000 surplus, right? And then this year what has happened is, basically at the end of the period, so the value has decreased. Okay, and then it has come down to 83, let's say. So you have a $2,000 difference, right? So that amount will be decreased from the surplus that you have in OCI. Okay, pretty simple. So I'll show you with the examples, that will be more easier. Okay, so when we are talking about depreciation, right, the key principle is that, so all asset with a finite life, okay, so it must be depreciated. And then, as I have already told you, the asset is only is charged depreciation when it is ready for use. This may be earlier than the date it is actually brought into use. Okay, and then residual, what is residual value? Is basically if you sell that particular asset, so what we do is we make an assumption what will be the ending condition of that asset. Okay, based on that, if it is disposed of today, how much amount we will get. That's all residual value is. So depreciation amount is basically your cost minus your residual value divided by number of years, you will get your annual depreciation. Okay, so depreciation should be charged on each significant parts of an item of PPE separately. So this is basically componentization. Okay, so as I've told you, like the engine will be accounted as a separate asset, right? And then it will be depreciated over its useful life, right? Or whenever the next overhaul will happen. So that's all it basically means. Okay, so depreciation begins when the asset is ready for use. We know that already, until it is derecognized, or when it is useless, right? Or if it has a substantial impairment, when the value will be zero, right? So depreciation must be allocated on a systematic basis, which is basically over its useful life, right? Reflecting in which assets future benefits are expected to be consumed. Okay, so it should reflect the pattern of assets future benefits as well. So similarly, you might have a question, right? Why is depreciation not recognized as per the revenue of that particular asset, right? So basically what happens is your revenue will be influenced, or it will be it will subject it will be subjected to inflation, sales prices, right? And then other economic factors. Okay, so such as competition and all that will basically be determining your sales price and all, right? So based on that, it'll be different. Okay, and then the depreciation method, residual value and the useful life of an asset must be reviewed annually and revised if necessary. If necessary, okay. So depreciation is accounted for as a change in accounting estimate only. Revaluation gains and losses. So basically, what you do is revaluations Any gain and losses is basically included in OCI, and then it will be held within uh, equity section, okay, as a revaluation surplus. Revaluation losses will be recognized in SOPL, okay, not in OCI. Always remember that. And then when a revaluation loss arises on a previously revalued asset, it should be deducted against the revaluation surplus, as I have already talked with you, right? So this will be a journal entry, basically. Debit revaluation reserve, if there is a reserve, right? And then debit SOPL for any residual loss. If that amount is greater, then credit your NCA, non-current assets, okay? So depreciation of revalued assets. So basically what we do is the amount, the asset which is basically being revalued as well. Okay. So the assets which is being revalued, what we need to do is that basically the amount which it has been revalued to, based on that we need to charge the depreciation on its remaining useful life, okay? So as you can see in the slide as well, based on revalued amount less residual value over its remaining useful life. So suppose it was bought at 100,000 and then the value went up to 150,000, right? So if the scrap value is zero, that means 150,000 minus zero divided by your depreciation, right? Earlier on, what you would be doing was your depreciation would have been less because you were only doing 100,000 minus zero divided by 10 or 20, whatever the useful life is, right? So if the value has gone up, the depreciation will also should also be going up, right? That's all it basically means, okay? And then based on that, you will need to make an adjustment in SOPL. So the revaluation surplus will only be realized when it is basically sold, right? Otherwise it will just be a profit in your book only, right? The amount of surplus realized is the difference between depreciation charge on the revaluation amount and okay, so it's just the difference, okay? The amount of surplus which will be realized is basically the depreciation on the revalued amount and then the depreciation that should have been charged, okay? This is basically transferred directly to retained earning. Journal is over here, debit SOPL, credit depreciation, right? Cumulative depreciation. And then in case of revaluation, when you transfer it, debit revaluation surplus, because this will have a credit balance, right? And then credit retained earning, okay? So when will you derecognize any asset is basically when no future probable economic benefits are expected from that particular asset, okay? Or when you dispose that particular asset. So a profit or loss on derecognition is the difference between the net proceeds and the carrying amount, okay? So any profit or loss, you will recognize it in SOPL, right, for the period. It's basically the carrying amount of the asset and then the net amount that you have received from selling, right? There might be gain, there might be loss. So when a revalued asset is disposed of, so what you can do is debit revaluation surplus, credit retained earning, or you could just leave it in the revaluation surplus within other component of equity, okay? So it just means no entry is required. So disclosure, what you will need to basically disclose is that, so what was your basis of measurement, and then you'll also need to dispose, I mean when you're disposing it, no, I mean like when you're depreciating it, you'll need to show its useful life, what's the depreciation rate, what is the depreciation methods used, and then you'll also need to provide a reconciliation of carrying amount at the beginning and the end of the period on notes. It will always be in the notes, okay? Look at any balance sheet, any balance sheet. So what is reconciliation? It's just opening balance, closing balance, and then the adjustment between the for the year, okay? any publicly listed company, just go and have a look in the notes. You will see this reconciliation. Okay, so if the PPE are restated at revalued amounts, information how the revaluation was done, that is also crucial, because the investor will require that information. Okay, what's happening? Okay, that's pretty much it. So what I have done is I'll be doing few more questions about this. Okay, so since I have done very fast over here, it's just that it's easier to understand this thing. Just have a look at the slide, and then it's easier to understand it when you're doing the problem. Okay, so when you get on with the problem, it will be easier from there. Okay, so just the slide is not enough for the conceptual clarity. Okay, so we'll be looking at that as well. So until that time, bye bye.